Hi there, my name's Tony from Savvy Profit, and our goal today is just to help businesses really get the most out of their accounting numbers. Because when you think about it, the accounting side of the business generally can be the most mundane, boring and annoying part. We want to actually try and take all that away and reverse that idea of accounting, and so the business owners can feel confident and get some drive and passion because of a good system in place that can help them, give them direction for their business. So our goal is to empower business owners to understand and use their business numbers proactively. And the result is personal peace of mind and business growth, including confidence. So what are the three fundamentals of a healthy business? Well, we think there are three pillars. They all start with the letter S. What's the first one? Structure. Have you got the right business structure for your personal circumstances? So here's a question. If I were to give you these two options, on these two motor vehicles on the screen, which one would you choose? You've got a buggy on the left-hand side, or a Ferrari or a sports car on the right. Which would you choose? Now, you might be leaning towards always to go for the sports car as the right car for you. But what if you were sitting on a beach and you needed to go through soft sand? Well, sports car hangs about that much off the ground. You're not going to get very far on soft sand. It'll just bog, and you'll be stuck there, and it'll be rendered you completely useless. In that case, the beach buggy is the better option. Well, therefore, what this teaches us is that when it comes to structure, we need to use the right one for our business and our own personal circumstances. So how many business owners actually sat down with an accountant or a lawyer to discuss structure, what's best for them? It could save them thousands of dollars down the track, and it could be a much better way of running their business. What are the four basic business structures, and what are the differences? What factors would you think about or need to think about in choosing the right one for you? Well, there they are there: sole trader, partnership, company, or trust. Now, the two on the left, a sole trader or a partnership, are very low-cost, easy structures to run. You're getting into more complex and higher end as far as costs go for a company or a trust. So which one would you choose? Well, you wouldn't normally always go for the low-cost option. It depends what you want to achieve. The factors you would want to think about are this. Do you want to benefit from the ability to divide your income amongst family members? You could save potentially thousands of dollars by doing this. If that was the case, you wouldn't necessarily go for a sole trader or partnership because all the income goes to the individuals in those business structures. A second factor you might think about: do you want to protect the assets, your personal assets, when it comes to running your business? Well, you need to think about what level of risk do you have running your business. A high-risk business with high amount of debt, you would want some level of asset protection too. So again, you would shift away from the sole trader or partnership structures because your personal assets are up for grabs in those structures. You might be able to move towards a company or trust structure. And a third aspect too is that sometimes your clients will only deal with a certain business structure. For instance, to avoid superannuation, they might say, we only want to have contracts with companies and not individuals. So there's just a couple of factors you would need to think about. But there's things you can do to, in fact, maximize the benefit of a business structure by combining structures. For instance, what if you wanted to divide income but also have the strong measure of asset protection? You could then combine the company structure with the trust structure. How so? Well, you would have a company as the trustee of the trust, and that would sit above the trust business structure that would trade, and you'd be able to divide income but also have the asset protection as the trustee becomes personally liable for the debts of that trust. But if it's a company, your personal assets are in fact protected. Or another set of circumstances might arise in your case. Let's say you have two people with two separate families coming together in partnership to run a business. Now, would they necessarily just form a partnership? Well, no. They could potentially, if they're running a high-risk business and they want to benefit from dividing income amongst members of their family, they could combine again a company and trust structure, but this time we're flipping it the other way. And what we mean by that is two trusts actually own shares in the company. The company trades and that pays income to its shareholders as dividends. And then once those dividends are paid to those trust shareholders, that can then be divided amongst family members, and tax benefits can be gained by splitting income in that way. So a number of different circumstances can arise in relation to choosing the right structure, but the takeaway is get the structure right from the start. It'll save you thousands. Case in point, had a client of ours, he actually came to us, he was leaving his paid work on wages, wanted to start a business. Now, he was just going to jump into a sole trader, a business structure. We talked about his circumstances. He then set up a trust structure that ended up saving him almost $8,000 in his first year. So yes, it pays to get it right and think about structure right from the start. What's our next S in the pillars of your business? Systems. And that is, many people run business like looking through the rear view mirror of their car. What do we mean by that? Well, think about this. When you record transactions for your business, you need to know exactly where you're sitting and how your business is running. Now, if you're looking reactively to report financial data that occurred months, maybe sometimes even years in the past, it's like you're running your business looking through the rearview mirror. Now, how comfortable and confident would you be driving a car like that? So it's a reactive cycle of accounting we want to avoid. So what would it mean for you knowing the future versus guessing the future? Well, would that mean peace of mind and control? Now, what's involved in doing this? Well, having the right systems in place. Now, what do we mean by that? If you've got accounting transactions being carried out on a day-to-day basis, the time you actually carry out those transactions, the time it takes to process the transactions, and then the time it takes to get reports, meaningful reports that will give you an idea or a health check as to how your business is running, that could be months, sometimes even years apart. That is not a great way to run your business. So it's important to have accounting software in place where you can record and receive timely information when you need it. So you're shifting the view from the rear view mirror, now looking at the front windscreen of your car. You've got control and you know exactly where you are and where your business is heading. So what do you need? You need a good accounting package. Now we know Xero is the Rolls Royce of the accounting software industry. Yes, you can use others, but use a system that's going to mean that there's not much time for you collating, searching around, finding information. Find an efficient software package that will enable you to effectively get a system in place. So you need to choose the right software, but also you need to choose who uses the software well. Don't just try and muddle around thinking, what does this mean, or how am I going to process this? Engage someone to process the transactions accurately. So rather than waiting for the end of the year to get figures on your business health, well, really, we would recommend you doing that during the course of the year. That means you need to correctly allocate transactions in your accounting system. Know the GST rules and things such as knowing whether to cost something or to allocate something to an asset account or expense account. How do you account for loan, principal and interest? What about depreciation? Now, these things often occur at the end of the year, and your accountant might do this as part of the end of year accounting cycle. But again, that's way too late. You want to allocate or know how these transactions can be recorded during the course of the year so you know profitability as it occurs each month. And that's what we'd recommend as the best way to do it. And it isn't necessarily a highly expensive thing to do. So Mike IT Guru often says to me, the problem lies between keyboard and chair. I always say to him, well, the computer made the mistake. Well, he tells me, well, there you go, you have it. He knows where the problem sits. And the same thing can apply with our accounting system. Oftentimes it's like, if we don't have the skill to make sure that data is recorded accurately, then we're not going to get really good and reliable information out of it. So yes, make sure you choose the right program, but also the right people to actually use the software. That brings us to our next S in the pillars, and that is stats. Know your numbers. Now, what a cliche, know your numbers. What does that mean? Well, we want to try and help business owners to know a few basic numbers out of their accounting system to know exactly where they're going as far as their business goals are concerned. So let's say, for instance, you've got this car. Now you're looking at the front windscreen, but just imagine that you've got no steering wheel. Well, it wouldn't be a great way to drive a car either, would it? You need to put a steering wheel on the car to be in control. So knowing your numbers, having stats in mind, as they occur, as the business is running, can help you and give you confidence in driving your business forward. So let's narrow it down. What are a few basic stats that you need to know? If you're going somewhere on a drive, for instance, the two things you need to know. Firstly, you need to know where you currently are sitting. Where are you in your business? So to do that, you need to consider two aspects. Firstly, do you know what the break-even point of your business is? Now, break-even point is the first signpost in running a business. Now, the break-even point means you need to know how many sales you need to achieve, or what your sales target should be, to cover all of your costs, all of your fixed costs. And so you also need to consider that sometimes you have variable costs that change with your sales targets. So with these three variables in mind, sales, variable costs, fixed costs, we can ascertain, or you can ascertain, what your break-even point is. In other words, how much of your product you should sell, or what your sales target should be to actually cover your costs. Now, this is important because if you're not reaching break-even point, then you will not succeed. Your business will not continue to run unless you continue to throw money into it. And no one wants to be in that position. We also need to know, once we've achieved our break-even point, if that's the case, are we actually making a profit in our business? What is our current profit? And that's all about knowing where you're currently sitting. But then you need to think to yourself, well, am I happy being here, or do I want to move somewhere else in another direction? Is your current profit enough? This is, where are you headed? What are your profit goals? So what factors should weigh in on finding or trying to set a profit goal for your business? Well, there are two things. Firstly, you need to think about the time and energy you've invested in your business. If you were to engage a business manager or a CEO, what would you pay them to do the job you're doing? So that would be at least a profit goal that you would need to reach. But is that enough? Just paying yourself a wage out of your business, is that enough of a profit goal? Well, no, it shouldn't be. The reason for that is that if that were the case, then why not go out, close your business, you avoid the stress and the risk, and you could go and get a paid job and achieve the same result. You need to also, on top of the income you're earning as part of your time in the business, you also need to be able to get a return on your investment in the business. So that should be an add-on to what your profit goal should be. Once you have a profit goal, then you can work out what your sales target should be. And then you can really create or have the drive and energy to proactively chase that sales target. So let's say you've got a good profit goal and you actually have profitability showing on in your financial statements. Does that mean everything is rosy? Well, here's an interesting concept. Profitability does not necessarily mean that your business is future-proofed. Why we say that? Because this is where you need to look at your balance sheet, and many business owners don't even know what to look for when it comes to their balance sheet, as long as they're making a profit. Well, here's a very simple tip that you can take away from your balance sheet. Your current ratio. When you look at your balance sheet, you need to make sure that your current assets, that is, assets that can be converted easily into cash, that exceeds your current liabilities, debts that you need to pay off in the short term. So the current ratio is your current assets divided by current liabilities. Now, if you've got timely transactions recorded in your accounting system, they're accurately done, you can look at your balance sheet at any time and actually look at and see to make sure that this is in fact the case. This ratio is above 1. That is, the current assets exceed current liabilities. That means you'll be able to pay off your debts as they fall due and don't risk going out of business. A case study, Mr. Jim Junkie, enthusiastic about starting a gym, and they were excellent at what they did, excellent personal trainers. So they had targets that they wanted to reach in relation to their business. But sometimes business owners just have a gut feel for how things are going through maybe a bank account balance, and they don't really understand what their numbers in their accounting system are in fact telling them. So they felt that they only need 5 more members to break even. Well, we sat down with them, went through their figures, worked through the analysis, and they came to realise that they needed 40 more memberships to break even. Now, just imagine if they continued on thinking that everything was okay and they were close to break-even point. Well, they wouldn't be as energised, they wouldn't really have been able to make clear moves and targeted moves to get those extra 40 more members. So how important it is that you're getting information out of your accounting system that's relevant, reliable, timely, and can drive you to take action for your business. So takeaways for today, Structure, it pays to get the structure right from the start. So sit down with your accountant or lawyer and just work through what is going to be the best structure for you and your circumstances. Secondly, have systems in place, the right software, but also the right people using the software so that you can make sure that you can get good information out of your system to know exactly where you're heading. And thirdly, once you have a good system in place, then your reports will actually mean something. And you can use your accounting numbers to fuel confidence and drive for your business. So how do you feel about running your business? Well, we want you to feel like this guy in his red Ferrari or his red sports car, sun is on, he's happy, he's confident, and he knows exactly where he's heading. And you can achieve this if you think of those 3 S's: structure, systems, and stats, and get them right.